Hello fellow compounders. What do you do when you see a sale? Say you see your favorite toilet paper on sale for half price. Or what about Amazon gift cards selling at 50% off? You take advantage, right? Occasionally, businesses go on sale in the stock market. I believe that this is one of those times. So in this video, I'm going to take advantage of Mr. Market. I'm going to go hunting for candidates to buy for my conservative coffee can portfolio. So let's get started. As usual, my standard disclaimer applies. This video is for educational purposes only. It is not investment advice. I am not your financial advisor, and you are responsible for your own financial decisions. As I filmed this video on October 22nd, 2022, Mr. Market is offering many businesses on sale for your picking. This is a perfect time to buy stocks for my coffee can portfolio. A coffee can portfolio is a crutch to trick me into holding stocks for a long time and letting them compound undisturbed. I did a video about coffee can investing, which I highly recommend watching. Here's the link. I have 3 coffee cans. The first one, the No Brainer coffee can, which is my 401k retirement account that has low-cost index ETFs. Second one is the Moonshot coffee can, which has small caps that have the potential to be 10 to 100 baggers. And my third coffee can is the conservative coffee can, which has the best of breed consistent compounders. To put things into context, here is a table of the multiples I'm expecting and the annual returns needed to produce the returns multiples for each coffee can. Over a 10-year period, I expect the No Brainer coffee can to be a 2-bagger, the conservative coffee can to be a 3-bagger, and the eclectic coffee can to be a 4-bagger. Eclectic coffee cans was defined in our previous videos. I don't have one in my portfolio currently. And the Moonshot coffee can, which can be a 5-bagger or more. When the market is in turmoil, I love to go hunting for big game because they are harder to find on sale in normal market environments. My definition of big games is large to mega cap companies, blue chips, best of breed businesses. Since these are large capitalization companies, I'm expecting a 3-bagger over 10 years. So that means I need to find businesses that can compound consistently around 12% a year. So let's go hunting. Here's what I'm looking for. Number 1, I'm looking for a business that I can understand or I'm familiar with. Number 2, for businesses that have a moat or sustainable competitive advantage, which usually means a consistent return on invested capital, ROIC, or return on equity. So I'll screen for a return on invested capital greater than 10%, and a return on equity greater than 15%. Number 3, they have to be led by honest and capable people. This is usually reflected in their financial stewardship and how they treat their shareholders. I prefer companies with little or no debt, so I look for a debt to equity ratio of less than 1. And number 4, I want companies that I can buy at a very attractive price. For dependable best of breed companies, I'm looking for at least a 20% discount. That means a price to fair value ratio of 0.8 or less. And by the way, if I were looking at small caps, I would be needing a larger discount, something in the range of 50%. So what did we find? Here's what I found today as big game potential hunts for the coffee can. Drumroll please. Number 1, Alphabet, symbol GOOG. And the second one is Microsoft, symbol MSFT. 2 elephants, mega caps on sale. Let me show you why they're interesting. First, let's start with Alphabet. Alphabet, ticker GOOG, formerly known as Google. Actually, we all know it as Google. It's a conglomerate mega cap that owns 7 platforms with over 1 billion users. It has Google Maps, Google Search, Chrome, Gmail, YouTube, Android, and Google Play App Store. It also has other businesses that it has started or has acquired to develop. Its main revenue source is online advertising. Google is the #1 provider of online ads. I bet that you probably use at least one of Google's platforms every day. I like that CEO Sundar Pichai is hungry. He has set out to make Google 20% more productive this year. Google is a compounding machine with a really deep moat. It has a market cap of around $1.3 trillion. This mega cap that still continues to grow consistently. Online ads are growing, and it owns YouTube, is tied with Netflix for the first place in video streaming, and it has a cloud business that is taking off. Morningstar puts its fair value estimated at $169 per share, meaning that it's trading at a price to fair value of 0.60 or a 40% discount. The forward PEG ratio is 0.74, this is really cheap for a company like Alphabet. The return on invested capital is 25.8%, which is really good. The return on equity is 29.2%, which is also good. And the debt to equity ratio is 0.11. That means it has very low leverage. Over the past 5 years, the stock has compounded at an average of 15.3%. This is more than sufficient to give us at least a 3-bagger over 10 years. I'm very confident that Alphabet will be around in the next 10 years. So that's Alphabet for you. Our second big elephant is Microsoft, symbol MSFT. It needs no introduction. It's the granddaddy of software companies. It's been around since the PC revolution started. It started with Bill Gates licensing MS-DOS to IBM. Then it made the first spreadsheet for Mac, which was Microsoft Excel. It created Windows, PowerPoint, Word, Outlook, OneNote, OneDrive, Teams. It also owns LinkedIn. Since 2014, Satya Nadella, its current CEO, reinvented Microsoft into a cloud leader. It provides infrastructure as a service and platform as a service services. It also converted its Office 365 to a subscription model, giving it a continuous cash cow. It's been a compounding machine for decades, and it will likely continue to be for decades to come. Microsoft market cap is around $1.8 trillion. Morningstar's fair value estimate is $352 per share. At current prices of $242, the price to fair value estimate ratio is 0.68. Means that Microsoft is currently trading at around a 32% discount. Its forward price to earnings growth ratio is 1.67, which is a little bit on the higher side, and its return on invested capital is 33.23%, which is very good, and it's been consistent. It's a great company. And its return on equity is 47.1%. And its debt to equity ratio is 0.37. That is 3 times more levered relative to Alphabet, but that's still pretty low. Microsoft is one of the bluest of blue chips in the software industry. It's best of breed. Its return on capital is stellar, and it's very consistent. At 33% return on invested capital, it's awesome. I mean, I think this company will continue to compound for a very, very long time. So we went hunting for a stock to stash in our conservative coffee can, and we found two blue chip companies. I like both of them. However, if I had to choose one of them, I would pick Alphabet because of 2 things. Its projected growth is a little bit faster than Microsoft, and 2, I'm getting it at a forward price to earnings growth ratio that is less than 1. It's a steal at these prices, and it's also trading at a 40% discount to the fair value estimated. So there you have it, Microsoft and Google, or Alphabet. I'm definitely going to be adding more Google to my portfolio, and potentially, or actually I'm going to add Microsoft too. I like both of them. If you'd like to continue learning how to compound your money, go ahead and subscribe to the channel. Thanks for watching, and remember to always be compounding. See you in the next video. Take care.